All right, let's dive right into this. Domino's Pizza just dropped their second quarter 2026 financials. And if you just glance at the surface, management is pitching a narrative of serious, undeniable momentum. They're out there touting this order count growth and an earnings per share jump that honestly looks structurally sound from the street view. But what happens when you actually walk inside and inspect the load-bearing walls of this business? You start to see virtually flat U.S. same-store sales and some real international headwinds that might just be masked by aggressive, relentless unit expansion. Welcome to Iron Financial. I am your lead analyst, and my mission here is to help you forge a stronger portfolio and cut through market weakness by looking strictly at the raw, unfiltered data.
And I'm here as the market skeptic, representing you, the viewer at home. Because let's be real, when a company tells me they are engineering growth, I want to know for sure if it's real, organic consumer demand, or if it's just financial scaffolding holding up the stock price. If you want to build a truly resilient portfolio, one that can withstand any market shock, you need to hit that subscribe button and ring the notification bell right now. We are bringing the building inspector's hammer to Domino's Pizza in today's explainer, so let's get to work.
Here is the drill-down blueprint for today's explainer. 1. The blueprint on revenues. 2. Operations and store growth. 3. Load-bearing walls and margins. 4. Structural integrity and leverage. And finally, number 5, the verdict.
Section 1. The blueprint. Revenues. Let's go ahead and inspect this top-line foundation.
To truly understand Domino's structural framework, you really have to understand that this isn't just a pizza company anymore. It is a highly engineered, finely tuned supply chain and franchise royalty machine. Total revenues for Q2 2026 hit a formidable $1.194 billion. That is a solid 4.3% year-over-year jump from the $1.145 billion we saw in the second quarter of 2025. When we actually break down that top line to see what's driving it, the absolute powerhouse doing the heavy lifting is their supply chain segment. That segment alone pulled in $731.7 million. It's a massive piece of the pie.
Right, and let's be extremely granular about exactly why that supply chain revenue is up. The 10Q filing explicitly states this increase was driven by higher order volumes, yes, but crucially, it was also driven by a 2.2% increase in the company's food basket pricing to its own stores. Think about what that means. Corporate is actively passing inflationary costs straight down to the franchisees. And while we're on the top line, we absolutely need to address the U.S. company-owned store revenues. They actually decreased by $10.6 million. That's an 11.5% drop, bringing them down to $81.8 million for the quarter.
That is entirely true, but context is absolutely key for anyone modeling this business at home. That decrease in company-owned revenues isn't a sign of weakness. It's a direct, engineered result of their strategy to re-franchise certain markets. It is an intentional, asset-light pivot. They are actively trading direct, boots-on-the-ground store revenues for U.S. franchise royalties and fees, which, by the way, consequently grew 5.1% to $164.2 million. They are choosing to take on less operational risk at the local store level while locking in that highly predictable top-line royalty stream.
Okay, I'll concede the logic of the refranchising pivot. It makes sense on paper, but I'm going to tap the walls here anyway, because part of this top-line facade is artificially propped up. Let's look at international franchise royalties. They came in at $81.8 million. But nestled deep in the footnotes of the filing is the fact that $1.1 million of that revenue increase was purely a foreign currency exchange rate tailwind. Without that favorable currency translation padding the numbers, that international growth story looks a little less robust. It acts as temporary scaffolding. And why does this matter for your portfolio? Because currency tailwinds are fleeting. Organic fundamental demand is what actually builds compounding wealth over a 5 to 10-year investment horizon.
Let's move to Section 2. Operations, store growth, and footprint expansion. The physical footprint expansion is really doing the heavy lifting for that revenue growth we just talked about. And we can see the exact math right here in the SEC filings. Domino's opened 209 net stores globally in the second quarter alone. Breaking that down, that is 26 net new stores here in the US and a massive 183 net new stores internationally. If you zoom out and look at the trailing 4 quarters, they have added 995 net stores. They now operate well over 22,500 locations worldwide. I want you to just think about the sheer capital expenditures and the localized logistical effort required by the franchise base to add nearly 1,000 operating units in 12 months. This is aggressive, relentless footprint expansion perfectly designed to capture market share by sheer proximity to the consumer.
It is aggressive, absolutely. But as the resident skeptic, my job is to ask if that raw unit expansion is masking a much deeper structural flaw. Let's talk about the unit economics of those specific locations. Because pouring millions of tons of concrete globally doesn't guarantee you'll actually sell more pizza out of each building.
The core duel of this entire earnings report lies right in these specific metrics. Global retail sales growth, excluding the foreign currency impact, was up 3.0%. That is a solid headline number for the trading algorithms to buy into. But when you isolate the same-store sales, meaning the actual organic demand at existing established locations, it is virtually flat. U.S. same-store sales squeaked by at a positive 0.1%. Meanwhile, international same-store sales actually declined by negative 0.1%. So CEO Russell Weiner places this heavy focus on his order count growth flywheel. But I have to ask, are they just outrunning weak core demand by frantically pouring that concrete and opening new units?
It's a fair challenge to the bull thesis, I'll give you that. But remember the context. U.S. same-store sales were rolling over a really tough comparison of a 3.4% increase in the prior year. The 10Q specifically notes that the 0.1% increase was in fact driven by higher customer transaction counts, though it was heavily offset by a lower average ticket.
And that lower average ticket is exactly what I'm zeroing in on. More transactions, sure, but lower tickets means the consumer is actively pulling back on the extras. They are buying the promotional $6.99 pizza, but they are skipping the chicken wings, skipping the soda, skipping the lava cakes. It's a real-time macroeconomic indicator flashing right there in the transaction data, showing us a very strained consumer.
Section 3, Load-Bearing Walls, Margins and Profitability Analysis.
Listen, top-line revenue and store counts simply do not matter if the margins are crumbling. The crucial point here is bottom-line profitability. And for Domino's, total income from operations actually increased by 3.1% to $232.0 million. The absolute bedrock of their margin profile is, once again, the supply chain. Supply chain gross margin increased to 12.0%, up from 11.8% last year. Now, a 20 basis point expansion might seem pretty small on paper, but when you apply it to over $700 million in quarterly revenue, the financial impact is immense. That generated $88.0 million in supply chain gross margin alone, which is up 8.7% year over year. The filings credit procurement productivity for this structural strength. Think about it. When you are buying cheese, wheat, and pepperoni for 22,500 stores, you essentially dictate the market price, completely offsetting the higher food basket costs through sheer economies of scale. Okay, the supply chain is strong, but let's inspect the pressure points, because there are absolutely cracks in the armor elsewhere in the income statement. General and administrative expenses spiked 7.2% to $64.4 million. A lot of that was due to elevated expenses from their biannual worldwide rally. But vastly more concerning to me as an analyst is the brutal compression in the U.S. company-owned store gross margin. It plummeted by a staggering 4.2 percentage points down to just 18.0% of revenues. Why did that happen? The 10Q lays it out mathematically. Food costs jumped 0.8 percentage points to 30.3%. Labor costs surged a full percentage point to 30.9%, and insurance costs are steadily rising across the board. If labor surges a full percentage point in a single quarter, what does the next 12 months look like for store-level profitability? The foundation at the individual store level is under severe, undeniable margin pressure.
I hear your skepticism on the store-level margins, but you really cannot argue with the enterprise cash flow durability here. Over the first two fiscal quarters, Domino's generated a rock-solid $352.6 million in net cash provided by operating activities. Furthermore, they spent a highly disciplined $39.0 million on capital expenditures, which leaves them with $313.6 million in pure free cash flow. Yes, it's a slight drop from the $331.7 million generated in the exact same period last year, but the 10Q clearly notes this was primarily driven by the timing of advertising fund payments, not a structural breakdown. This business model at a corporate level is a massive, highly predictable cash-generating machine.
And what exactly are they doing with all that cash? They are aggressively reinforcing the stock through very deliberate capital allocation. In Q2 alone, they repurchased and retired nearly 444,000 shares for $156.2 million. On top of that, the board maintained a hefty $1.99 per share quarterly dividend. For investors calculating their yield on cost at home, a nearly $2 quarterly payout combined with consistent, heavy buybacks proves this is a management team fundamentally committed to returning capital to shareholders. Full stop.
It is a mathematically aggressive strategy. I completely agree with you there. In fact, they still have a massive $1.23 billion remaining on their authorized share repurchase program. But as the market skeptic, I really have to point out the mechanics here. Buybacks often act as temporary scaffolding for the earnings per share metric. Let's look closely at the numbers. Net income for the quarter only grew 3.6% to $135.8 million. Yet,
Because they are constantly retiring shares and artificially shrinking the overall float, diluted EPS jumped 6.8% to $4.07. They are effectively buying their way to earnings beats. It's a legally and mathematically sound strategy, of course, but for anyone building a portfolio, it is absolutely vital we understand the financial engineering behind that headline EPS number. The underlying business grew 3.6%. The stock metric grew almost double that at 6.8%.
Section 4. Structural integrity, leverage, and the balance sheet.
In a higher interest rate environment, a company's balance sheet is its ultimate structural integrity. And to verify that strength, we bypass the polished investor relations press release and we go straight into the Form 10-Q filings to cut through the noise. We are looking for the real financial engineering. We need to know exactly how much debt is holding this whole structure together. If you want to talk about a genuinely solid foundation, look at their leverage management over the past year. The trailing four-quarter leverage ratio was successfully reduced from 4.7x in 2025 down to 4.3x in Q2 2026. This is on the back of generating an absolute unit of a metric, $1.104 billion in trailing consolidated adjusted EBITDA. To get to that adjusted number, they're taking net income and adding back interest, taxes, and depreciation. But they also reconcile non-cash items like stock-based compensation and those foreign currency translation impacts we discussed earlier. The key takeaway here is that they are actively growing their adjusted cash flows and successfully deleveraging the balance sheet simultaneously. That is exactly what you want to see. Okay, deleveraging from 4.7 to 4.3 is a step in the right direction, sure, but let's not pretend the house is fully paid off. I'm bringing out the hammer again for this one. They still carry a staggering total debt load of approximately $4.88 billion. Furthermore, because of years of those aggressive share buybacks and dividend recapitalizations we just discussed, they are currently operating with a total stockholders deficit of negative $3.98 billion. Think about what that means. The liabilities far exceed the assets on the books. This highly levered, asset-light, franchise-heavy model works brilliantly when the macroeconomic weather is sunny and global cash flows are highly predictable. But let's issue a stark warning here. If we hit a severe consumer demand shock, if that average ticket drops further and transaction growth actually goes negative, can a balance sheet carrying almost negative $4 billion in equity withstand the tremor? That is the ultimate structural risk to this stock.
Section 5. The verdict and final inspection. We've completely torn down the revenues, the store counts, the margins, and the balance sheet. From the lead analyst perspective, the bull case here is incredibly strong. Domino's is a textbook resilient compounder. They are building massive momentum through unparalleled supply chain leverage, driving 12% gross margins on over $700 million in segment revenue. They are generating over $300 million in pure free cash flow in just 2 quarters, returning a massive amount of capital to shareholders, and expanding their physical footprint by almost 1,000 stores a year. This business is a fortress.
And from the skeptic's desk, I clearly see the cracks in the armor.
Yes, total revenue is up, but it is heavily driven by forced price increases on franchisees through that very supply chain, coupled with massive net unit growth. The organic demand at the store level is totally stagnant, with U.S. same-store sales at barely 0.1% and international slightly negative. Store-level margins are getting squeezed heavily by labor and food costs. The foundation is highly levered, and the EPS growth is mathematically engineered through those stock buybacks rather than pure organic net income growth. So the ultimate question we leave you with today is Domino's engineering a masterclass in compounding growth, or is this portfolio builder simply expanding its physical footprint as fast as possible to outrun and escape a flatlining organic market? It is a critical question for any investor looking at DPZ right now. Drill down into the 10Q yourself, check our math, and decide if the structure belongs in your portfolio. Thank you for joining us on Iron Financial for this explainer. Don't forget to like, subscribe, and stay resilient out there.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.